In 1720, Paris, a man named John Law convinced an entire nation that wealth could be created out of thin air. He promised ordinary people access to unimaginable riches through shares of the Mississippi Company, land in America that most investors would never see. At first, prices rose. Then they exploded. Crowds packed the narrow streets of Paris, screaming, shoving, trampling each other in the streets just to buy one more share. Aristocrats sold estates. Shopkeepers quit their jobs. And then, almost overnight, it collapsed. Shares fell more than 90%. Lifelong savings vanished. France's economy was crippled for decades. The winners cashed out early. The losers held on, believing the story. I'm telling you this because the same pattern is happening right now. Hey, I'm Brian, and I spend way too much time thinking about why safe investing keeps blowing up at the worst possible moment. If you're someone who feels like you're doing everything right, index funds, diversification, long-term thinking, but still feels uneasy, subscribe and like this video. By the end of this video, you'll understand the exact mechanism that quietly concentrates risk in your portfolio without you realizing it. So, let's go back to 1720 Paris. So let's rewind and actually look at what happened in France in 1720, because the details matter. Here's what happened. John Law wasn't a random con man. He was the official controller of France's finances. After years of war, France was drowning in debt. Law proposed a solution that sounded brilliant. Create a company, the Mississippi Company, that would exploit the riches of French Louisiana. Gold, silver, trade routes, land. The promise was endless growth. At first, shares were issued at 500 livres. Then excitement built. The French government backed it. Debt was converted into shares. People thought, if the government supports this, how bad could it be? By early 1720, shares had risen to over 10,000 livres, a 20 times increase. But here's the catch. Louisiana wasn't producing anything close to what was promised. The land was mostly swampland. Trade revenues were tiny. The numbers didn't justify the price, not even remotely. Warning signs started flashing. Insiders quietly sold. Law restricted selling to maintain confidence. More paper money was printed to keep prices up. That only made things worse. Then confidence cracked. In a matter of months, shares collapsed more than 90%. Banks failed. Inflation exploded. Ordinary people were wiped out. France entered an economic depression that poisoned public trust in markets for generations. Let's talk winners and losers. Winners, insiders, early sellers, and the state, which offloaded its debt. Losers, everyday investors who believed the story and held on. Here's the kicker. The system worked exactly as designed. It transferred risk downward while profits moved up. So what does this have to do with investing today? Everything. Imagine you're building a house. At first, everything looks solid. Fresh paint, nice floors, strong walls. But instead of inspecting the foundation, you keep adding weight. Another floor, heavier furniture, a rooftop pool. And every time the house creaks, someone says, "Don't worry, houses always hold up in the long run." Let me ask you something uncomfortable. Would you keep stacking weight on a foundation you've never checked? Would you call that safe just because it hasn't collapsed yet? Because that's exactly what modern investing looks like. Today, over 30% of the S&P 500 is concentrated in just 7 companies. Back in the 1990s, that number was closer to 15%. We've doubled the concentration, yet we call it diversification. That's not even the point. The point is this: when prices rise, the system automatically pushes more money into the most expensive parts of the house. And if the foundation cracks, you don't lose a room. You lose the whole structure. And that's where this story starts getting very familiar. Let me tell you about something called the Nifty 50. In the late 1960s and early 1970s, Wall Street decided it had finally cracked the code. Analysts identified 50 one-decision stocks. Companies so dominant, so well-run, so essential that you were told you could buy them at any price and just hold forever. Here's what happened step by step. First, money flooded into the same handful of companies: IBM, Coca-Cola, Xerox, Polaroid, Avon. Second, valuations stopped matching. Some of these stocks traded at 50, 80 times earnings. Third, institutions justified it by saying they're safe. They always grow. Fourth, inflation hit, growth slowed, and reality reappeared. And fifth, the collapse. Between 1973 and 1974, many of these safe forever stocks fell 70% to 90%. Xerox dropped nearly 85%. Polaroid lost over 90%. Avon fell 86%. It took 20 to 25 years for some of them just to break even. Winners and losers? Winners. Institutions that rotated early and earned fees regardless. Losers. Long-term holders who believed quality means no risk. And the most surprising twist? Many of these companies survived and succeeded as businesses. The investors still lost. So what does this pattern look like today? Let's talk about the Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. Together, they now make up over 30% of the S&P 500. Nvidia alone grew more than 200% in a single year. Apple crossed $3 trillion. Microsoft isn't far behind. I'm not saying these are bad companies. They're incredible businesses. But that's not even the point. The point is how the math works. This is where it gets really interesting. If those 7 stocks drop 50%, not to zero, just back to historical norms, the index doesn't fall 10%. It falls 15 to 20% immediately. Add in correlated declines from the next largest stocks, and suddenly a diversified portfolio is down 25 to 30%. And most people never saw it coming, because they weren't betting on 7 stocks. They were told they were buying the entire market. But just like the Mississippi bubble, just like the Nifty 50, the risk wasn't obvious at the surface. It was buried in the structure. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. The system is designed to hide this risk from you. Here's how. First, there's a linguistic trick. The word diversified. When you hear that, you picture safety, spread risk, stability. But diversification by number of stocks is not the same as diversification by risk. You can own 500 companies and still be dangerously concentrated. Second, there's a technical sounding concept that actually makes this worse: market cap weighting. It sounds neutral, scientific, but here's what it really does. It forces you to put more money into the most expensive stocks simply because they already went up. That's not discipline. That's momentum masquerading as prudence. Third, there's long-term smoothing. Charts are shown over 30 or 40 years. Crashes get flattened. Volatility looks harmless. But you don't experience averages. You experience sequences. And here's the emotional reframe most people miss. You are not a passenger in this system. You are the product. The industry gets paid on assets under management, not on whether your retirement survives a bad decade. I'm not saying index funds are evil. I'm saying blind concentration wrapped in comforting language is dangerous. Which brings us to the most important part. What do you actually do about it? So, if I were starting fresh right now, knowing what I know, here's exactly what I'd do. Action step 1, awareness check. First, I check my actual exposure. Not the fund name, not the marketing, the holdings. I'd open my brokerage, click into my largest fund, and look at the top 10 holdings. Then I'd calculate what percentage of my entire portfolio sits in those names. If Apple, Microsoft, Nvidia, and friends make up 25 to 35% of my net worth, I'd stop pretending I'm diversified. Go look tonight. 5 minutes. Do it. Action step 2, counter strategy. Second, I'd implement what I call the inverse concentration strategy. Here's how it works. Instead of letting winners automatically dominate my portfolio, I intentionally spread exposure away from the most crowded trades. That means equal weight U.S. stock funds, international developed markets, emerging markets, small cap value, real assets like REITs or commodities. I'm not saying sell everything and go all in. I'm saying rebalance intentionally. Example, if I had $100,000 instead of $35,000 effectively riding 7 stocks, I might shift $30,000 into equal weight U.S. stocks. $20,000 international developed, $10,000 emerging markets, $15,000 real assets, $15,000 bonds, $10,000 cash. Same money, very different risk profile. Action step 3, valuation rules. Third, I'd set up what I call valuation tripwires. These aren't market timing. These are discipline. Rules like, if a holding exceeds 10% of my portfolio, I rebalance. If a sector trades at 2 times its historical valuation, I stop adding. If 1 year's gains account for more than half of my 5-year returns, I trim. Retail investors are told to never touch anything. Professionals rebalance constantly. Action step 4, defensive buffer. And this is the one nobody talks about. I'd build a defensive buffer. If I spend $50,000 a year, I want $50,000 to $75,000 in safe cash or equivalents. Not for returns, for psychology. In 2008, people with cash bought assets at generational discounts. People without cash sold at the bottom. This buffer turns crashes from existential threats into opportunities. It also buys you time, mentally and financially. Action step 5, time horizon reality. Finally, I get brutally honest about time horizon. If you're 30, a 40% drawdown is painful but survivable. If you're 55 and planning to retire in 10 years, it's different. That's sequence of returns risk. 2 investors earn the same average return. 1 retires rich. 1 doesn't, because losses came first. At 55, that loss might be permanent. And ignoring that reality doesn't make it go away. So, here's the bigger picture. The financial industry has spent 40 years convincing you that the best move is to be passive, hands-off, and fully exposed at all times. But here's the contradiction. The smartest pools of money in the world don't invest that way. Take the Yale Endowment. It doesn't try to beat the stock market every single year. It spreads risk across assets, geographies, and strategies. It prioritizes survivability over bragging rights. Now, you can't replicate Yale's portfolio. You don't have private deals or infinite time horizons. But you can replicate the philosophy. Avoid concentration, rebalance deliberately, and don't confuse simplicity with safety. That's the difference between investing to look smart and investing to stay solvent. So what would I actually buy heading into 2026? This isn't financial advice. This is a framework. Roughly 30% equal weight U.S. stocks, 20% international developed, 10% emerging markets, 15% real assets, 15% bonds, 10% cash. Would this beat the S&P 500 if the Magnificent Seven double again? No, it wouldn't. And that's okay, because wealth isn't built by hitting home runs. It's built by staying in the game. Most people won't do this. It's not sexy. It won't make you rich in 12 months. And it requires you to think instead of hope. But if you're still watching, you're not most people. So tonight, before the next headline, before the next hype cycle, go check your portfolio. Look at the concentration. That single step might matter more than anything you buy next.